Hey guys, what's going on? Alright, so in this video, I'm going to be going over what type of investor are you and where does your personality and investing strategy fit into the market. For those of you who are new to my channel, make sure to subscribe. I go over, investing, stock news, primarily in the tech industry, and, just try to give my information on overall financial literacy so that way you guys can really just take your money and grow it over the long run. Alright, so without further ado, what kind of investor are you? Let's jump right into it. The first strategy I want to go over is day trading. Now, if you are a day trader, you are going in and out of your stock positions within the same day. The most frequent times used for a day trader will probably have to be from open at 9:30 to, say about, the first half hour, so say about 10. Again at noon to 12:30. And then power hour, which is going to be between 3:30 and 4:30. Now, these 3 point in times are generally where there's the most volatility in the market, and that is what a day trader looks for. A day trader looks for volatility, because if there's volatility in a price, whether it be in a small cap or a large cap, there's money to be made. So day traders, they generally gravitate towards, penny stocks and, small market cap companies, because no matter what's going on in the market, they will normally have massive volatility because of how small the company is. And that means that if I want to invest, say, $10,000 into this micro cap, that is going to shoot that stock price through the roof in the short term. And so day traders, they only need a few $1,000s to really be able to ride the wave, per se, on multiple companies that are extremely volatile in any given time frame. Now, day trading is probably the highest risk to reward type of investor there is. So a day trader will be looking, they can get 5% gains in a day, which is kind of absurd, and they can also get like 30% gains in a day. They can get a couple 100% gains in a day, and they can also realize losses of those same quantities. And the majority of day traders, unfortunately, are not successful. I don't know if it's a true statistic, but the thing that's been going on online is that 90% of day traders fail. And that is because they start trading with emotion. They give up on their principles on where they want to get in and out and where their comfort level is. And a lot of people blow up their accounts because they start chasing money. So while day trading is, it can be very lucrative, it is something, especially for new investors out there, to really, really consider when you want to stick your money into, when you want to use your money to start day trading, because there's a high probability that you're going to lose all of it. All right, but anyways, let's go on to the next one. So the next strategy I want to go over is swing trading. So if you're a swing trader, you are kind of looking for momentum. Now, to be classified as a swing trader, you need to hold that stock for at least one day, and you're generally out of it, within a couple of days, couple of weeks, or at most generally, say 1 quarter, so like 3 months. So a swing trader is looking for a stock price that is, very cyclical, or it's following a very certain pattern over a certain period of time, and they want to trade in between the highs and the lows. So for example, if your stock price is doing, let's say this, like if it's going up, down, down, when it gets here, and you're expecting its next level of resistance to be here, and its next support to be here, a swing trader will want to capitalize on this region. So they will start the position around here, and they will exit around here. The second that this stock exits this threshold, and then will either go below the support value or go above the resistance value, they have to then reevaluate their trade, because now it is no longer in that exact pattern, and they have to look what happens. If it falls below the support line, the stock could plummet, and if it goes above the resistance line, the stock could shoot up, 10-20% within a minute, and then come back down into this bracket, or break the entire pattern and start a new one, start a new ascending pattern. So swing trading is, and I know that that's a very crappy drawing diagram, but that's just kind of so you get the point. There are, numerous YouTubers that really go way more in depth than I do with day trading and swing trading. I can give one of them right here. His name's Ricky. He's a pretty great guy. He's about my age. He's really into teaching people about how to, become a trader, how to become a swing trader, and how to do so correctly and safely. I don't personally day trade or swing trade often. I do it occasionally just when I see a really obvious pattern, but I'm not an avid trader. So I mainly stick to investing. So for all of you, for further in depth with anything like that, I'm going to refer you to his channel, and so that way you can start learning from him. The next investing strategy I want to go over is growth investing. Now, if you're a growth investor, you are searching for revenue growth or profit growth. You want to see constant improvement within any company. Now, when you start growth investing, you really tend to focus more on the medium cap companies. So by that, I mean between 1 and let's say 5 billion market cap. It's a 5. Mainly because these are the companies that are emerging, and they've really started to gain momentum, and they really started to solidify where their niche is and what their service is. And a lot of people are now starting to realize them, and they have a large room to grow. You can also growth invest in larger cap companies such as Facebook, Amazon, but those companies have been in their growth mode for a few years now, and they just don't offer as large of return as if you find someone who will be, say, the next Facebook and Amazon, if you get in on them when they're only a $1 billion market cap or they're a $5 billion market cap, whatever. And so the amount of growth that growth investors are looking for is generally double-digit growth. So you're looking for anything, 10+%, whether that be year over year or quarter to quarter. Aggressive growth investors will be looking, just for quarter on quarter. So, that's when you see like earnings reports making or breaking a company, is because if the earnings report comes out negative, and say this goes from 10% growth to, let's say, 4% growth, still positive growth, but all growth investors want to have nothing to do with this. And so they just completely sell their position and they find a new stock because they know that this company is no longer exploding. Unless there's a really good reason why this was a lower number than their last quarter, and there's some news that indicates that its next quarter is going to have an obscene amount of growth, most growth traders will immediately just pull out. Now, that's something that you really have to be worried about with growth investing, is when a company has an earnings report, you could, your stock could go up or down 20% in a day like that. And so people try to, a lot of people try to time earnings, and they'll jump in and out of stock because they think it's going to beat it. And unfortunately, because the market's kind of irrational, even if your stock beats earnings, it could still drop like nothing. And it's just kind of something you have to deal with. So growth investing is probably the riskiest investing and not trading route to go. I do a lot of growth investing myself. Fairly accurate at it. I have I'd say about an 80% accuracy rate with companies that I go on with growth investing. But that's also because I take a little bit of a different approach with growth investing. I add in a lot of psychology into growth investing. So I try to analyze the individual market, what the overall, attitude is for the other investors, and then I play accordingly based off that. So that's something it's really hard to explain. If anybody's interested in it, I can try to make a separate video specifically on that, on my own personal strategy. But a lot of it is driven from, in college, I've taken a good amount of psych courses. I do a lot of psychology research on my own time, and I'm just kind of applying that to investing, which is the only reason why my investment strategy really works branched off of this. So, yeah. But anyways, for a regular growth investor, they just want to capitalize on this. The second that they either see a better company that will have, like, say, they're in a company right now that has 10% growth, and then they find a company that's getting 20%, 24%, and then 30%, they're going to go right to here. They're going to completely get out of that position, and they're going to go right to here to maximize this amount of growth. And, for other growth investors, you really have to be on top of your stocks. And in my opinion, when you're a growth investor, that is when you have to be the most devoted to individual stocks that you own. You could only own 4 stocks, but you're going to have to be researching those for 4 to 6 hours daily just to make sure that you know what trend this is going in, to kind of give you a little bit of a leg up from your other investors. Knowledge is power, and when you're a growth investor, if you don't know something, it could cost you all of your gains immediately. And if you know something that other people don't, you could go up and down like 30 to 40% within a couple of days. Like one of my last most successful trade, a company that I was in tanked from one earnings report because it only had a 19% quarter on growth instead of, I think it was like a 32, which, a lot of growth investors want to pull out. The stock price plummeted. It was either 19 or 24%, something like that. So it's kind of absurd, but then I kept doing more and more research on that company. I was personally bullish on it for the entire next year and for the next one, so I tripled my position. And thankfully, the next earnings report came out, and the stock moved up. The stock had recovered a few, but the stock moved up 22% in 2 days. So I made a massive amount of money off that trade, which is great, but that was also extremely risky. And if that earnings report was also south, that stock could have definitely dropped another 20, 25%. So growth investing is very risky and something that you really, really need to know your in and outs, and you really need to stick to your strategy if you plan on being successful with this strategy. As any strategy, you kind of have to pick one and stick to it. And then the second you want to switch out of it and go to another one, you have to really go wholeheartedly into that one. You can't play multiple strategies. It just doesn't work out. And so for the last strategy I want to go over is long-term value investing. So if you are a long-term value investor, you are, following Warren Buffett and Ben Graham, and you decide to look for companies that you believe they are worth price X, they are trading significantly below that valuation, and you're willing to buy and continuously buy shares of that company until that company's market capitalization is finally realized. So this can take anywhere from a few years to decades to maybe even your entire life, depending on if you really like the company and you think it is just always going to be around, it's always going to be growing, or if the company, if you believe it should be a multi-billion-dollar corporation and it's only a few million or only 1 billion, you have to give yourself a very long time horizon to really follow this strategy. Now, value investors generally look for a couple of things. They look for old companies. Generally, a minimum of 10 years plus is what any value investor will really look into, because they want to know what the track record is of that company, and they want to make sure that that company is following along with the goal that they set out to do 10 years ago, and that they've had good progress making to that point. A lot of other value investors will be looking for a dividend. This is mainly because a lot of long-term investors, if you're letting your money sit there and you don't plan on ever taking it out to realize a gain for, decades at a time, you kind of occasionally you're going to need some money to live off of. And so when the company pays you a dividend and they'll give you a percentage of your position back, they can either use that, as for their daily lives, and they can use that as their income, or they can take their dividend and then reinvest it in a drip, and they'll just get massive gains over the long run between, just riding out and taking all of their dividends off from the top. Now, there are three main ways that people tend to try to value a company, and that's generally through intrinsic value, I believe that's how you spell it, intrinsic value, competitive valuation, and through opportunity. Now, all right, and so a very quick breakdown of what these three valuations mean. You have intrinsic value, which is the overall worth of the said company between their tangible and intangible assets. You have the competitive valuation, which is if this company is, say, on the e-commerce market and they're trading at a 22 PE, and they are overall a well-run company, but the average PE ratio in the e-commerce market is, say, 55, you then have to realize, okay, is the market overvalued, or is this company drastically undervalued because of its peers, and what position do you want to stake in based off of that? And generally, a long-term value investor will not be looking at anything that has that high of a PE, but that's just for simplicity to really kind of gauge you guys to really understand what's going through their mind. And then opportunity. So value of opportunity is, you find that a lot in the tech space and the biotech space. And if this company is developing this, say, cure for cancer, or this drastically new way of treating cancer or any other type of ailment, and if it goes through, the company would then, their valuation would go, like, say it would go up 10 plus times, and the company would just continue to grow after that point in time. All right, and so I know that this was a very brief overview of value investing along with all the other strategies, but I really wanted to just make a video that would allow, new investors to really understand that there are many avenues to go down when entering the market. And there are countless more than the ones that I went over in this video. So if you guys are all interested in an individual breakdown of any of these types of investing, or if you want me to go over any other ones that I didn't cover, just let me know down in the comments. If you guys want me to go over any stocks that you guys are interested in, throw it down there. I'm happy to answer questions or take some comments or feedback or anything like that. All right, anyways, like the video, dislike the video, give me some feedback. And if you guys aren't already subscribed and you stuck around for this long, please subscribe. I'll try to put out as much content that I think you guys will like as often as possible. All right, see you guys.